The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome, everyone, to this week's episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that feds need to know in 15 minutes or less, sometimes a little bit more if I get to talking. So whether you are a seasoned federal employee or whether you are just starting out in your career, Fed15 has got you covered. So grab your coffee, kick back, and we'll tell you what you might need to know but may have missed in the space this week. I am your host for this week's episode, Katelyn Murray. Other weeks I may or may not be Katelyn Murray. And Dan has made the unfortunate decision of taking some time off and thus leaving me with unfettered access to you, the listener. So apologies in advance as we dive into this week's episode. So a couple interesting things that we have to talk about this week. We're going to talk a little bit about that C Fund and your TSP. It is a beloved hero to some and a very scary specter maybe to others. But we'll talk about C Fund, what it is, what it isn't, and kind of a more durable way to use that C Fund in your TSP allocation. And then once we have kind of covered C Fund, we're going to also talk about the use it or lose it rule for annual leave. Now, this is a very popular topic with the feds that we talk with throughout the years. And we're going to talk a little bit about how you can manage that a bit better. I think often this is something in the financial planning like plate that often gets overlooked, maybe until fall or December. And then people start scrambling, trying to make sure that they're not going to give up any annual leave time. So we'll talk about a more sustainable way to track and manage all of that as well. But before we get there, let's talk about this C Fund. So what is the C Fund? So the C Fund is one of the 5 investment options, not counting those life cycle funds, because those are pre-made mixes of the core 5 TSP funds. You've got G Fund, F Fund, C, S, and I. Now, the C Fund tracks the S&P 500, and it holds mostly large cap U.S. stocks. The performance of the C Fund is going to reflect the performance of established U.S. companies in equity markets. Now, markedly, what it does not include are small cap stocks, bonds, or non-U.S. markets, which kind of makes sense. Interesting little piece of trivia. This isn't in the article, but C Fund, the C in C Fund actually stands for common stock. If you were curious, now you can impress everybody at the water cooler at work. Do they have water coolers anymore? I don't know. Maybe at cocktail hour. Importantly, what you need to understand about C Fund is that it represents one segment of the market. It is not a complete portfolio in itself, and it should be used as a component of a broader TSP strategy, not the entire structure. So if you were listening to this and you were invested 100% in C Fund, not just you have a lot of C Fund, but if you are 100% in C Fund, you should reevaluate your TSP allocation. Just like, by the way, on the opposite side of the spectrum, if you're 100% in G Fund, you should also evaluate your TSP allocation. All right. So risks of that 100% C Fund portfolio that we can talk about, right? Concentration risk is going to increase near retirement. You also have a high degree in that C Fund of timing risk, okay? So the S&P, without getting into the charts and the graphs and all of that, the S&P has a very well illustrated cycle. If you Google an S&P 500 chart, you can see it, of, rising prices followed by returns or followed by periods of correction where the S&P 500 or the C Fund, we can use those terms interchangeably, is down, right? The issue with the S&P 500 in particular is that sometimes those periods of correction are double-digit years. The most recent one was 12 years, between 2000 and 2012, the S&P 500 was flat or down for that entire period, right? So something to be aware of there with the timing risk. The other thing with C Fund, behavioral, on the behavioral side, you guys know if you're a routine listener of the podcast, I love behavioral finance. I kind of come at financial planning from the world of financial psychology and behavioral finance. And the C Fund carries a high degree of behavioral risk. Why? Because when we see those strong markets like we have been seeing as of late, the allocations in the C Fund and the TSP tend to increase, right? So when you see something that's doing well, you want to get on the train, you want to get on the boat. You also want to do well. So you buy in when you see the price going up. And then when the price starts to decline, when we get into those correction periods, then people start selling off, right? So you end up because of that behavioral element, you end up doing the opposite of what you want to do, right? You always want to buy low, sell high. Problem is with our very illogical, irrational human brains, that's kind of hard to do. So we end up buying in when the price is on the rise, when the price is high, and we sell when the price starts to decline, when the price is low. So you want to ideally do the opposite of that in your investment strategy, okay? So that's a concern with C Fund as well. So how do we kind of utilize C Fund in a meaningful way? Well, I'm not going to give any specific allocations because your TSP investment allocation should be unique to you. It should be based on your own financial goals, your own financial context, and your risk tolerance for volatility in the portfolio, as well as your risk capacity, which is the amount of risk you need to take to reach the goals that you have. All right. So we're not going to give specifics, but here are some broad strokes. All right. C Fund primarily you're going to be looking at for growth. All right. But you're going to combine it with other funds like G and F that provide stability and liquidity for spending needs, right? On that bond side. And then S and I on the equity side, you can incorporate to diversify beyond large cap US stocks, right? S Fund is going to be more small cap. The index there is a little debatable, but we won't get into that on today's episode. And I Fund, the international fund, so that you have US and international. Because interestingly, in some of those periods, and it was like this between 2000 and 2012, when we're seeing the S&P being a little challenged in those correction phases, international tends to outperform, not always, but it tends to outperform during those periods of time. So it's nice to have both because then you kind of get a bit of like a yin and yang effect in the portfolio. Okay? And overall, what you want to make sure of is that your allocation reflects your time horizon and your withdrawal timeline for the TSP. So in conclusion, we want to make sure that we're using C Fund as a valuable growth component in the portfolio if it makes sense for your own unique context. But we want to avoid a heavy reliance that could create some structural risk during market stress. And overall, we want to look at intentional allocations that can improve the long-term durability and what you're seeing there in your TSP, okay? And remember, we talk about it a lot on this podcast, diversification. Above all, diversification is going to help you manage risk. Note that I didn't say avoid risk, but diversification is going to help you manage risk without abandoning growth potential, okay? So if you're interested in learning more about the C Fund, you can hit our website at STWServe.com. We have a ton of articles there. We have one article in particular it goes through all of the 5 core funds in your TSP so that you can learn more about, all 5 and learn what kind of major concepts could help you build your own TSP allocation. All right. So now that we've talked about TSP a bit, let's talk about annual leave. So this is a little bit less of a long-term thing. This is more of a short-term focus. And I think a lot of times in financial planning, we get really focused on the long term, right? We're optimizing things around retirement. And that's not necessarily a bad thing, but I do think that it's important to remember that balance, right? Because whether we want to admit it or not, no one is promised tomorrow. No one is promised 10, 20, 30 years from now. And while we absolutely want, everyone that we're interacting with, all of our Feds, everybody in the Fed community to have a wonderful, long, happy, healthy retirement, The reality is that in order to be healthy, you need to balance your long-term goals with those short and midterm goals. So annual leave is kind of more of a short-term thing. We think about it kind of in terms of current year. So the annual leave accrual rates, if you don't know, if you have been a Fed, and this is in general, right? There are always exceptions to the rule. But in general, if you have been a Fed for less than 3 years, you're earning 4 hours per pay period. If you have between 3 and 15 years of service, you're earning 6 hours per pay period plus a potential final pay period bonus. And then if you have over 15 years of service, then you're looking at 8 hours per pay period that you're earning, right? So fairly generous annual leave. There is a standard carryover cap each year of about 240 hours. Now, there are some exceptions to that rule. There are several exceptions to that rule, but namely the folks who are overseas employees and senior executive service members may have higher caps that are in place. But in general, most Feds are looking at a 240-hour cap on annual leave, right? So what that means is if you've got 240 hours is the most hours that are going to roll over for you between leave years, right? So if you've got anything over that, when we hit the end of that leave year, it goes away. And we don't like that, right? You should take your annual leave and, use it for what you see fit. Use it to bring balance to your life. Use it to recharge. We all kind of need that, I think, after 2025. So typically that leave year is going to end in early January. You can find the dates actually on the OPM website. I think through 2030, they have published when the leave year ends. But any excess leave that you have after that date where the leave year ends is going to be forfeited unless there are extenuating circumstances of workload or schedule conflicts. And then that will be communicated. And then that will be communicated by your superior, right? Or your HR department. So how do you calculate your carryover limit? Well, you want to look at your most recent leave and earning statements for your current annual leave balance. And then you want to subtract your carryover cap. Like I said, for most people, it's going to be 240 hours, but feel free to adjust if you're SES and you're listening to this, or if you have a different leave cap. You want to subtract your carryover cap from that leave balance to determine the amount of hours at risk. Now, if you're reviewing this early, it's going to increase your scheduling flexibility, okay? Because here's an important piece. Holidays do not extend your leave year deadline, okay? Delaying your review of what you're looking at leave-wise until fall or December is going to reduce your available options. Couple reasons for that. One, there isn't time for you to take that leave, right? If you're finding out in December that you have like 30 hours of leave that you need to take, it's kind of hard to get that in with like 2.5 weeks left in the year and some of those days being holidays, right? And then the other factor there is competition, right? Everybody else just sat down and reviewed their annual leave status, and they just found out that they have 30 hours that they need to use it or lose it time. And so they're buying for those days to take off as well. So they're submitting leave requests at the same time, okay? So the best time for you to do this is actually early in the year, and you can kind of calculate what you're going to be earning annual leave-wise throughout that year, and then you can plan, right? You can take some of that time, divide it up between the quarters or however you want to manage it. Annual leave represents paid compensation at your current salary. So if you are forfeiting leave time, you are losing income, okay? You're losing that paid time with no payout. This is your time. This is part of your compensation package, and I encourage you to take it, right? Now, don't take it all, because we have lots of articles and episodes about how annual leave can be really helpful to you as a lump sum payout to supplement your FERS pension when you retire and you're on that interim pension period, right? I know a lot of my folks who separated from service in 2025 they've leveraged that annual leave payout to really supplement during that extended interim period for the FERS pension. But at the same time, I don't want you to be giving away time that you could have used, like I said, to bring balance to your life for recharge time. So again, make sure you're looking at this early so that you can kind of schedule it throughout the year. You can get your requests in first to beat that kind of year-end competition, and treat it really as planned time, not leftover time. Okay? So, a couple of tips that you can use to avoid losing hours this year in 2026. First of all, you want to mark your leave year end. If you know the leave year end, you get a gold star for today. But if you don't know, I will tell you. It's January 9th, 2027. Okay, so the 2026 leave year ends January 9th, 2027. So if you got 242 hours on January 9th, 2027, you're losing 2 hours, right? The other 240 will carry over. You want to schedule extended trips early whenever possible, again, to beat that leave competition. You can use shorter absences or long weekends to kind of steadily reduce your excess hours, depending on what your workload's looking like. You can also combine your annual leave with federal holidays for extended breaks. We have an article about that on the Serving Those Who Serve website. You can just Google leave strategy, and it should come up to show you kind of how you can take those federal holidays and kind of extend those breaks into longer weekends to kind of use up some of that time as well. Overall, early planning is going to improve your approval odds, and it's also going to help your department or your office kind of balance the coverage so that you're not leaving your colleagues in the lurch, okay? So if there's anything you could take away from this segment of today's episode, I want you to take away that leave is a financial benefit. You are entitled to it. Promoting leave is going to support your compensation, and it's also going to support your well-being. And you need to integrate your leave planning into your broader financial strategy that kind of improves your long-term balance, again, between those long-term goals and the shorter and mid-term goals, okay? So the thought of feds who work so hard giving away leave hours really bothers me, so do not forfeit your hours. Take that time, but plan ahead so that you'll be able to, all right? Okay, so that is all the information that I have for you today, folks, but I will be back with my tried and true co-host, Mr. Dan Sipe, next week to bring you all the latest updates that you need to make informed decisions about your career and financial well-being as a Fed. And so that you can make sure that you're here for that episode, please, please, please subscribe to our podcast on our YouTube channel or on Spotify, depending on where you listen, so that you never miss an episode. And also, please share with your friends and colleagues so that we can, again, broaden that signal. We want to widen that signal. We want to make sure every Fed understands their benefits, okay? Now, for more information on the topics that we covered in today's show and more, make sure that you check out our website at STWServe.com. While you're there, you can subscribe to our newsletter, The Weekly Serving, to get all the latest news for Feds delivered straight to your inbox every single week. Another good tip that I'll give is make STW Serve your homepage so that every time you open up your computer, you've got the latest news for Feds right in front of your face. And for those who want to dive even deeper into learning about your federal benefits and financial planning for Feds, you're saying, Katelyn, this information sounds great, but I really want help weeding out what doesn't relate to me and zeroing in on what does relate to me. We encourage you to join us for one of our complimentary webinars. We've got some great ones coming up here shortly. We have tax planning that is coming up on February 26th. That'll be from 1 p.m. to 4 p.m. And the lovely Jen Meyer will be hosting that session. We also have a session on Social Security coming up on March 4th. That'll be from 11 a.m. to 2 p.m. And I'm actually hosting that one. And then the following day, we have a session on FERS. That's March 5th from 1 p.m. to 4 p.m. And I am hosting that one along with Dan Sipe. So you can see us both in that session on FERS. That's a great place to start, by the way. If you've never attended a webinar with us, the FERS webinar or the financial planning webinar, those are the two that I normally recommend you start with. If you prefer a one-on-one approach, you want a relationship with a trusted advisor who can kind of help you personalize all of this material, feel free to reach out to our team directly for a financial planning consultation. You can do that at meetings@stwserve.com. So thank you very much for keeping me company this week and listening to the Fed 15. I am Katelyn Murray, and I will see you next week.